I thank the gentleman from Georgia. Now, we don't have anyone from the other side. Obviously, if they come, they'll be recognized. But seeing the lack of members on that side, the chair will now recognize the gentlelady from Wyoming.
Thank you, Mr. Chairman. Kind of following in on this theme, I'm from Wyoming, the smallest population in the nation. There really are no big banks in Wyoming, none. We're completely reliant on community banks, and so the thought that we'd all have to drive to Denver or Salt Lake or to bank for an entire state is absurd. Professor Marsh, I want to ask you, does too big to fail give systemically important institutions an advantage that community banks can't get?
Well, to clarify, what do you mean by too big to fail? So do you mean
systemically
significant designation?
Yes.
That hasn't really been my focus of my research, but there are a number of people who would argue that that's true. I think it is true that that designation means that many people in the marketplace consider that the government, even though Dodd-Frank repeatedly says we're not bailing anyone out, the marketplace doesn't believe it, and the marketplace is giving a premium to the larger banks at the expense of the smaller banks. So
why doesn't the marketplace believe it?
I think because if you allow an institution to remain that large, if we found it difficult to imagine a world where they all cascaded in failure 5 years ago, and they've only gotten bigger since then, how can we imagine a world where the government would allow them to all cascade in failure this time?
Mr. Kramer, why doesn't your bank believe it?
Because it's been the practice that too big to fail, whether you are a financial institution or an automobile manufacturer, it has just been a practice that you've been bailed out. The moral hazard has been created. And as a financial person, we fully understand that a $2.3 trillion financial institution that can manipulate the electricity market cannot be allowed to fail.
So how is this going to affect the needs of customers in states like mine and communities like Mr. Collins in northern Georgia, very rural areas? What are we going to do?
Well, as Mr. Miller said earlier, and he's accurate on residential loans, that all the forms are basically the same. Not so on small business loans where the forms can be different. But the difference is the customers are not all the same. And in a community bank, it's about the story of the customer. It's about the need of the customer, what the customer is trying to accomplish, and how can the community bank help that customer accomplish what they're trying to accomplish. Because if we're successful in helping a small business owner accomplish what they want to accomplish, then they hire more people. More people potentially bank with us. More people then potentially borrow for their homes and their cars, which makes our community stronger and makes our bank stronger, and it's just a good thing.
So how many Fortune 500 companies do you think are incorporated in Wyoming, have their home offices in Wyoming? What would you guess? Anybody?
None.
You got it. So with places like Wyoming or any of these districts that are really comprised of small towns, what is the future for the borrower, for the small business person? The small business person.
The future should be a strong, viable community banking system.
How do we get it back?
We have to relieve the overwhelming regulatory burden off of the community banks, and we have to allow community banks to be able to effectively compete in the niches they compete in.
Professor Mars, and you can answer that as well, but in addition, would you answer this question? Will the regulations coming out of Dodd-Frank make smaller banks more or less able to compete with larger banking institutions?
Well, I'll answer both questions at once, if I may.
That'd be great.
Because I think that, as I've said before and others have said, the issue is not to look at Dodd-Frank in a vacuum, because no bank can look at Dodd-Frank in a vacuum. It's regulation by accretion. So it's on top of decades and decades and decades of regulations that the banks have to deal with. And so that's our problem, right, that we just react to crises and add new laws. And what we need to do is take a step back and fundamentally reimagine what is the appropriate way to regulate a bank that is located in rural Wyoming, and most of its business is farm lending.
And the community banks, did they create this crisis that Dodd-Frank was built to address?
I do not think so.
I yield back, Mr. Chairman.
I do have additional questions,
Okay.
Mr. Chairman.
Chair recognizes gentlewoman from Wyoming for 5 minutes.
Thank you very much. Could I ask any of you to comment on the proposed Basel III regulations?
Well, I mean, I would just say that, first of all, having our regulations decided by central bankers across the world and imposing one uniform standard doesn't seem like the wisest approach to me. But second of all, the focus on risk-based capital, which Basel III embodies, is, I think, a very dangerous approach because it homogenizes the banking sector further, and it forces people to try to gain. I mean, it's an invitation to arbitrage, and that's
And
what
isn't
happened
it
in
true that banking is more concentrated in Europe than it is in the United States?
It is. We have a much more competitive landscape than Europe does.
So Basel III, Mr. Creamer, would do what to American banking?
Well, to go back very briefly to what Mr. DeSantis had said about regulation incenting some things, first of all, risk-based capital regulation incented residential mortgage loans because they were risk-weighted lower and it required lower capital requirements. In many cases, there's more inherent risk in a residential mortgage loan than there is in an owner-occupied commercial real estate loan to an operating business. In addition to that, Fannie Mae and Freddie Mac put explicit government guarantees. Now, they were implicit at the time, but we all know they're explicit. So when you have an incentive to capital and you have explicit guarantees by the government in a product, you'll probably create a price bubble. Basel III doesn't really address that. Basel III still risk weight residential mortgage loans at 50%. So there's still an encouragement to make residential mortgage loans. It still risk weights small business loans at 100%. Right now, each quarter, my bank files a call report. That call report is about 78 pages. All banks file call reports. The call report instructions are 626 pages for that 78 pages. This is a mailer we received last week from a very reputable brokerage firm with a breakdown of Basel III as it relates to community banks. Basel III doesn't simplify that. It makes it more complicated for our staff to calculate. And while they say they have simplified the definition of leveraged capital, I'd simply refer to one section of this, which is about 16 lines of the deductions from what is qualified as regulatory capital. And I am a banker and an accountant by trade, and I don't recognize the acronyms that are in here. And these are the ones that supposedly apply to me.
I hear a lot about Basel III from the banks in my communities, and they're expressing true alarm over them.